Good morning, everyone. You've tuned in to ET now. This is Market Cafe. I'm Karunya Rao, and over the next 1 hour, we'll look at all the important cues before we start with the trading session for today. Starting with the global trade setup, well, the handover does not seem very encouraging overnight from the western part of the world. If you look at the Wall Street, Dow Jones stumbled about 165 points, settling lower by 0.7%. In fact, it was mainly the tech and financial names which was weighing heavy on that index. It was in fact the worst performing index among the other three benchmarks. The S&P pulled back 0.9%. The Nasdaq Composite dropped 1.5%. On the Nasdaq, it was Amazon and Alphabet which declined about 1.8% and 1.4% respectively. Declines in Facebook and Netflix also contributed to the losses on Nasdaq. Financial gave back gains from earlier on in the session, notching a record 13th day of loss. The financial sector, in fact, the SPDR fund closed about 1.3% lower. Bank of America, JP Morgan, Morgan Stanley, Citigroup, all of these fell at least by 1% in yesterday's trading session. In fact, Dow intraday, if you look at it, it rose as much as 285 points earlier in the session as a crackdown on Chinese tech investments by Trump administration was less restrictive than expected. But overall, it's been a weak handover from Wall Street. But the latter part of the US that I was talking about, the fact that the crackdown on Chinese tech companies was less restrictive than expected. Because of that, we saw European markets breathe a sigh of relief. Of course, it was the rise in oil prices also which helped the European markets edge higher, but also the trade concerns alleviating that really helped the stocks on in the European markets. Pan-European Stoxx 600 rose about 0.7%, having reversed the losses that it saw earlier on. Almost all the sectors ended in the positive territory, with exceptions like bank, which saw a bit of a selling pressure. Of course, even on the Wall Street, we saw financial names be a big drag, and even in the European markets, banking was what was curbing the gains. FTSE gained about 1.1% in trade. DAX was higher by 0.9%. CAC was the only one which was underperforming in yesterday's trading session, which was down by 0.9%. The region was given a lift primarily because on the back of Wall Street trading higher during its morning session. So European markets primarily replicated the session that we saw on Wall Street in the first half of the day, where the stocks and where the major bourses were very much in the green. Moving on to Asia, let's see what kind of a start is it bracing itself for. Well, ASX 200 is in the green territory with marginal gains of worth 17 odd points. Apart from that, the Nikkei and Shanghai are very much in the red. Nikkei is clocking triple-digit losses as we speak, down by about 147 points. Kospi is also reeling under pressure, down by 0.7%. The US said they will use a review committee to address concerns over foreign acquisitions of US technologies. That is something that is weighing heavy not only on tech stocks in the United States but also in the Asian market. Of course, the restrictions, rather impositions that Trump's administration made on tech stocks, tech investments by the Chinese companies in the US, that is also an element which is playing up in the Asian markets in early trade. Talking about Nikkei, losses were mainly in the energy sector. The shares actually did popped in the last session, but just now they are reeling under a bit of a selling pressure. Airline names continue their descent as well. Automakers are the only one which are in the bright spot right now, higher by 0.6%. That is for Toyota, which is aiding some support to the market. Kospi is also at a similar level of losses, like I said, down by about 0.6%. Tech stocks are struggling big time. Samsung Electronics is down 2%. SK Hynix is down almost 3%. Despite the former settling a dispute with Apple over patents, we saw SK Hynix get into a patent issue, or rather Samsung, not SK, but Samsung, which was in amid a patent issue with Apple that got resolved. But despite that, a bit of a pressure coming by in that particular stock. Let's pull up the SGX Nifty. Well, that one is also not looking very encouraging this morning. 10,642, where it's currently perched at with a loss of about 30 odd points. So clearly, we are very much bracing ourselves for a bit of a weak start in today's session, but of course one can see an otherwise move as well, so we'll wait and watch till 9:15 how the Indian markets begin. Meantime, keeping it with the global news and the latest saga of the back and forth trade negotiations, Between the US and China, Donald Trump backed away from more aggressive curbs against Chinese investments in US tech firms, temporarily soothing trade war fears. In a statement, the White House said it would back plans to strengthen an existing process to review foreign investments in the US companies. While still likely to keep such investments in check, the move is less aggressive than expected. That's why we saw a bit of a relief in the European markets, but clearly not being replicated in Asia. Previously, it has been reported that Trump was considering barring many Chinese firms from investing in the US tech industry. Trump, however, has denied those reports. Now, the White House plans to back a piece of potential legislation that would give the Committee on Foreign Investments in the US more power to decide whether a foreign investment may be a national security threat or not. That piece of bipartisan legislation has passed both the Senate and the House and is awaiting final vote from the Congress. The White House economic advisor Larry Kudlow has a different opinion. According to him, the administration's revised approach towards China should not be characterized as a retreat. Instead, he explains that the decision to use the committee is simply a modernization that will protect US technology. Kudlow reiterated that Washington is hoping to resolve its differences with Beijing, but in the meantime will remain vigilant. Moving on, Blackstone's Byron Vine, who predicted that some lurking geopolitical factor would upset the US markets a few weeks ago, says that the S&P 500 is on track to hit 3,000 in the next half of 2018. The vice chairman of Blackstone Group Wealth Unit believes that it is the upside investors must look forward to. His comments come after he earlier said that there are factors that could upset the stock market. Despite geopolitical risks, he believes that the robust earnings will aid market returns. Moving on to some corporate news, Harley-Davidson may face a downgrade of its corporate credit rating because of retaliatory tariffs by the EU. S&P Global Ratings warned of the possible downgrade, citing concern about near-term cost increases because of EU tariffs. S&P warned in January it was worried about Harley-Davidson's sales declines. Harley-Davidson said it would lose as much as $100 million a year because of the EU tariffs on motorcycles that it ships from the US. Those tariffs are a retaliation for trade penalties imposed by the Trump administration. Moving on, St. Louis Fed President James Bullard said one big risk to the US economy in coming years might be his colleagues raising interest rates to a level he believes would restrict growth. He added that rates could already be at a neutral level already, and the central bank may go too far if it stays on its path of further rate hikes. In an interview with the Wall Street Journal, he cautioned that the Fed must go slow on rates on year and warned against believing that the neutral rate is closer to 3%. Meanwhile, a foreign affairs advisor to Russian President Vladimir Putin said Moscow and Washington reached an agreement Wednesday on the date and location for a summit of Putin and Trump. Presidential advisor Yuri Ushakov made the announcement after a meeting in Moscow between Putin and US National Security Advisor John Bolton. The time, venue and other details of the summit will be announced jointly by the Kremlin and the White House on Thursday, Ushakov said. He said the summit would take place in a third country but did not name it as part of the plan for a joint declaration with Washington. Meanwhile, a leaked report from China-backed think tank that has warned of a potential financial panic. This being seen as a sign that some of the policy elite are growing concerned as market turbulence and trade tensions rise. The study goes on to say that bond defaults, liquidity storages, and recent plunge in markets pose particular dangers at a time of rising US rates and a trade spat with Washington. The think tank warned that leveraged purchases of shares have reached levels last seen in 2015 when a market crash erased $5 trillion of value. The study provides another indicator that China is growing concern about the knock-on effects of trade tensions with the United States. And more corporate news, Apple and Samsung just ended their epic 7-year legal patent infringement fight. The terms of settlement have not been disclosed. The two companies agreed to a settlement in the case according to court documents which were filed on Wednesday. The settlement closes a dispute that started in 2011 when Apple accused Samsung of slavishly copying the iPhone design and software features. A jury awarded Apple $539 million in May, leaving Samsung with an outstanding balance of $140 million it owed Apple. It was not clear yesterday how much more, if anything, Apple will receive. And clearly we saw that the stock, however, did not react very well to this news despite a big setback, big problem being solved on Samsung's part. Let's take a short break on this point. We have more lined up over the next 30 minutes, so be back soon.